there. Welcome to The Open here on BNN Bloomberg. I'm Lindsay Biscaya. Let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. Statistics Canada says retail sales rose 1.1% in January. Sales at motor vehicle and parts dealers led the gains. The strength was broad-based with increases in all provinces, including a 0.9% rise in Ontario. Looking ahead, an early estimate points to another 0.9% gain in February, suggesting consumer spending is holding up despite economic uncertainty. FedEx shares are moving higher in the pre-market today. The transport company raised its full-year profit outlook, signaling its confidence in the global economy despite ongoing geopolitical turmoil. The company also noted that although it does not expect the war to have direct effects on its business, rising energy prices and volatile shipping patterns are notable trends adversely affecting the global economy overall. In a reversal from Meta, the company is keeping its Horizon Worlds VR platform alive after backlash from its users. The platform was set to be shut down on its Quest headsets, but Meta now says existing games will remain available for the foreseeable future. It's a partial retreat from CEO Mark Zuckerberg's metaverse push as the company shifts more focus toward mobile, where most users' activity is already happening. And we'll take a look at U.S. futures to start the morning. You can see all trading down at the moment. The Dow down by 0.2%, the NASDAQ 0.3%, the S&P 500 about the same. The TSX is a really interesting one that we're watching this week. It's basically erased all of its gains that it's made so far this year, with basic materials acting as the biggest weight on the index. And we'll take a look at the price of oil as well, set for another weekly surge as the war in the Middle East continues. Brent up about 6% this week, and you can see WTI up by 0.7% at the moment. Gold, also another interesting one. This is part of the reason we're seeing that drop on the TSX overall. Gold set for its worst week in 6 years as the war in Iran curbs rate cut bets. And the price of gold down more than 7% this week at the moment, down by another 1.4%. We're also tracking the loonie, of course, rising slightly against its U.S. counterpart, given everything that's happening in the Middle East. We're going to take a quick break, but coming up, if you're planning a spring getaway, your options may be fewer than you think. We'll tell you how global tensions are changing Canadians' travel plans. That's coming up next. For Canadians trying to escape a never-ending winter with a trip down south, it's been an unusual year. Global instability has meant fewer options and sky-high prices. CTV's senior correspondent Judy Trin reports on how travelers are adjusting.
Your luggage is taken care of.
This retired couple is booking their flight to Asia and their cruise a year in advance.
Japan and then Southeast Asia. And we're really looking forward to Japan.
But buying tickets early is already costing more than expected.
Prices go up 20-30% on flights for the summer, so people are starting to plan a little earlier and really hoping that they capture those savings before the prices go up even more.
The war in the Middle East is driving up the price of jet fuel. The average weekly price has climbed to $175 US a barrel, compared to $99 the week before the war on Iran began. Air Canada, WestJet, and Air Transat have already increased their fares. Other international airlines have tacked on fuel surcharges or reduced their routes. From the Middle East to the Caribbean, it has been a tumultuous travel season. Power outages and food shortages in Cuba forced airlines to suspend flights. Cartel violence in Mexico's Puerto Vallarta scared away some travelers, including these women who paid $500 more for their vacation package in the Dominican Republic.
When they didn't have gas and power, that's when it went up, but not for Cuba because we couldn't go. Yep. And then that's why we're going to Punta Cana. Even we wanted to go to Mexico.
Despite global conflicts, some travelers remain determined to see the world.
We're at a point in our lives where either do it now or never.
The low Canadian dollar is also having an impact. The loonie is currently hovering at about 73 cents US, where it's been stuck for the past 3 years, leading Canadians to choose destinations where their money goes further. Judy Trin, CTV News, Ottawa.
Dubai has long been considered a safe haven in the Middle East, but Iran's unprecedented strikes against U.S. allies across the region have put that model to the test. So for more, here's this Bloomberg documentary.
These attacks were unprecedented. We could not have imagined this scenario actually playing out.
Most airports and airlines in the region are affected.
Drone has hit a residential tower overnight in Dubai. It sparked a fire and residents were forced to evacuate the building.
This conflict has come to the doorstep of a territory that many perceived to be one of the world's top safe haven territories.
That perception was by design and helped attract both money and talent. The strikes threaten more than lives and infrastructure. They're testing Dubai's model of stability and the image it wants to project.
Iran's formerly supreme leader, Ayatollah Khamenei, is dead. We've already won in many ways, but we haven't won enough.
Thousands of deaths across the region have been reported in the war begun by the US and Israel. Iran's wave of retaliatory strikes targeted US allies, prompting the UAE to prioritize safety above all else.
Iranian strikes have hit airports, military bases, even data centers.
The UAE has seemingly defied what many assumed would be an existential threat. It's navigated peril before, but with war on its doorstep, can it do it again? Dubai is one of 7 emirates in the UAE. Even as instability has reshaped the surrounding region, the UAE has made itself extremely attractive to foreigners. The city of Dubai was one of 6 founding emirates in 1971, and since then it's transformed from this to this.
Dubai's population is mostly made up of expatriates. You're talking about 90%.
From the UK alone, we've had owners of Premier League sports teams, hedge fund founders, heirs to some of the world's biggest fortunes move to the UAE just in the past year alone.
You can have the beach, you can have the luxury hotel, and you don't have to pay tax.
This influx has led property prices to skyrocket in recent years, particularly in Dubai. Look at London, Hong Kong, Los Angeles, and New York. Now add Dubai, and you get the picture.
Dubai has really become a global financial center. They've made a really big effort to court everyone from the individual billionaires to the hedge funds, to the private equity firms, the Wall Street giants, you name it.
And there's a reason for this.
The UAE leadership is very keen to diversify away from oil.
Instead, it is focused on developing key industries, including tourism, finance, and trade. And so far, the strategy's worked. The income from oil in Dubai's economy is now negligible. And since 2022, the number of hedge funds in Dubai has nearly tripled. The UAE is also making big bets on AI, committing to invest more than $100 billion over the next few years.
The UAE has seen massive investments from the likes of Amazon and Microsoft.
It is, in fact, a region-wide venture, with over 200 data centers already built or in development. But these have become targets.
AWS warning of prolonged disruptions to its services after drone strikes damaged 3 of its data centers in the Middle East.
One really has to wonder, if we do have a long war ahead, how much appetite there will be for building data centers in a region that is so close to Iran and a destabilizing conflict.
And then you have the tourism industry. Dubai's airport is the world's busiest international hub, and its flagship airline, Emirates, is the world's largest international carrier. Dubai's success attracting people and businesses was bolstered by its image of safe money and safe streets.
You could leave your Birkin bag on the table, walk away, and when you return, it's still there.
In Dubai, there is zero income tax, zero national insurance tax.
Hey, aren't you going to take your things?
No.
Why?
It's Dubai.
A big part of Dubai's success as a financial hub is its stability first model.
That means you have the whole infrastructure of everything from finance, your physical security, your medical, everything that you might need to feel secure, to feel safe.
These countries really want to offer something a bit more like Singapore, where maybe personal freedoms are not as plentiful as in the West, but at the same time, they can argue that domestic unrest is kept at a minimum. So it's really about putting stability at the expense of everything else.
Police are extremely vigilant. They have zero tolerance for all sorts of crime. People feel extremely safe in Dubai. And that's part of the problem that we're seeing right now. I think you live in a place like Dubai, your guard is down. And then all of a sudden, you realize that you are in a region that can see this level of violence.
We've seen a barrage of attacks from Iran to U.S. allies in the Gulf region there.
With conflict ongoing in the region, what of the stability first strategy?
Goldman Sachs and Citigroup said to have told staffers in Dubai to stay away from their offices.
Wall Street banks are offering their employees to relocate temporarily.
There's always been a geopolitical risk for where the UAE is and where Dubai is. What they have managed to do so well is make their domestic market so secure that people feel really secure living there, but they cannot shift where they are in the world.
Geopolitically, they've always been able to hedge and play both sides. There are military bases in the region, but at the same time, they've always had to navigate their proximity to Iran. And there's an almost unspoken agreement that Iran would never really want to attack these hubs because there are Iranian financial interests there too.
Dubai's faced major challenges before, and in many ways, it's capitalized on them.
Most famously, around the time of the 2008 financial crisis, there was a big credit crunch and the property bubble in Dubai burst.
We saw property prices plummet by 50%, 60%, people fleeing. People had a lot of debt and they just left it. And at that time, Dubai wasn't ready to handle that kind of a downturn.
Bloomberg News has learned that Dubai's sovereign wealth fund has quit making investments and it may sell off some of its assets.
In the end, its sort of bigger brother, Abu Dhabi, had to step in and provide financial support for Dubai. It came back stronger, stronger than ever, many would say.
Then a decade later, there was the pandemic.
People stopped coming to Dubai. It really had to think about how it would survive for that time. And it did, to be honest, through being as efficient as possible in opening up its economy as soon as it could.
It also implemented a number of measures to attract global talent, including making it easier for foreigners to obtain long-term golden visas.
Dubai and the UAE have shown themselves to be resilient, even when they've been almost out for the count.
The question is whether it'll be able to do the same this time. And for now, the message from the top, at least, is one of reassurance.
So the leadership of Dubai, but also the leadership of the UAE, have been keen to show people that it's safe. They've been photographed walking around in malls. They've been interacting with the public. They're basically keen to tell people to go about their lives.
With Iran selecting a new leader who may be unwilling to back down in the face of the US and Israeli bombing campaign, uncertainty prevails.
The Strait of Hormuz has suffered a high level of disruption since this war began.
The Strait of Hormuz is a really important global choke point. It's basically the only waterway from the Persian Gulf into the open ocean. And it's a hugely important trade channel for energy products.
And while Dubai has diversified its economy, it can be affected by supply chains. The immediate impact of the war on other industries in the region may be harder to measure.
It's an incredible region. It's got very significant growth. Those are the types of asset classes and geographies that we want to be investing in long term.
No matter what happens between Iran and the US, there's still going to be a huge drive to do business with long-term, deep pools of capital.
it is all up in the air. People barely know what's going to happen next. But history has shown us that Dubai can adapt very well to a crisis situation.
If I'm in Dubai right now, or if I'm thinking about moving to Dubai, the question I'd be asking myself is, can I be here for the long term?
One of the reasons why Dubai works so well is that it's a haven, not just for business, but also for tax. And that might help answer the question of whether or not Dubai remains an attractive place for them.
We're going to take a quick break right now, but you are watching The Open here on BNN Bloomberg, and we'll be back in just a moment. The current restrictions in the Strait of Hormuz have forced nations to look elsewhere for energy. Canada is one place they have apparently been turning to, but many say our lack of infrastructure and slow approvals process for building new infrastructure adds up to missed opportunities. For more, we spoke to Francois Poirier, Chief Executive Officer at TC Energy.
Customers aren't going to wait when they need to contract for LNG. They're not going to wait for any particular country who could supply their LNG to finish their regulatory process. They're going to sign up for that capacity when they need it. And of course, with the geopolitical situation that's going on, there's certainly a sense of urgency around securing LNG from different parts of the world to diversify their sources of supply and, of course, look for paths that avoid the Strait of Hormuz. So being a bit more outcome-focused, being a bit more focused on the time-bound nature of the opportunity, I think is really important.
How long does it take for some other countries to get major projects approved?
We can just speak to our own example. On our Southeast Gateway pipeline in Mexico, from our original application to receipt of our full permits was 7 months. It was a project of national priority. We certainly didn't cut any corners in terms of environmental assessments, in terms of consultations with landowners and indigenous groups. And another example would be in Germany, when the conflict in Ukraine broke out. They went from concept to actually a regasification facility to receive LNG being put entirely into service in about 1 year and 2 months. So there are examples of countries being able to do this.
Okay, you've remarked about the demand and how much it's increased since the start of the conflict in Iran. How much more gas could you export if the infrastructure was available today?
Well, right now, we're only moving about 2.5 billion cubic feet per day through the LNG Canada facility. Of course, LNG Canada is contemplating a doubling of that capacity to 5 BCF a day. There are 2 other projects that are looking to get built for LNG export, which would add about another 2.5 billion cubic feet a day. But I think we should aim high. Let's be the largest exporter of LNG to Asia, and that would be in that sort of 12 BCF a day range. The resource is there in the Western Canadian Basin. We have the know-how. We have a delivery advantage from the west coast of Canada to ship to Asia. It's a much shorter distance. It's about 8 days shorter than shipping from the Gulf Coast of the United States. And let's go after the business.
Is it worth investing now? Are we already too late? Does Asia have elsewhere to turn?
Well, this opportunity has come back around to us a second time, which is why I'm really making an effort to speak to this opportunity again. 15 years ago, we were at the start line of the LNG export business in North America with the U.S. Neither one of us had any export capabilities. If we were playing a hockey game right now, the score would be 8-1. We have one facility that's been commissioned and in service. The U.S. has 8, and they are the largest exporter of LNG in the world. I thought the opportunity had come and gone, but because of geopolitical tension, because natural gas has emerged as the fuel of choice around the world to balance affordability, reliability, and sustainability, the opportunity has come back around for Canada to punch above its weight, which will help us, of course, grow our economy. It'll help us diversify our economy away from the United States and create wealth for Canadians.
I wanted to get you on data center build out, the hyperscalers building everywhere. Does TC Energy have any direct contracts related to that build out, either in Canada or the U.S.?
We tend to focus on serving the utilities, who in turn take the gas that we deliver them and generate power, and they're the ones who've been selling power to the data centers. Nevertheless, we've seen quite a bit of growth opportunity in terms of building out our pipelines to serve the utilities, who in turn are serving the data centers. And we see ourselves investing perhaps up to another $10 billion to serve that market over the next few years.
Okay, let me also ask you about Bruce Power. I know there was consideration of expanding the facility there. Is that still on the table?
Very much so. Right now, we're in the middle of the refurbishment of the 6 existing units, and we've been very successful in bringing those in on time and on budget. Ontario definitely needs more nuclear capacity, and we're very interested in speaking with the Ontario government about expanding Bruce Power to deliver an additional 4,800 megawatts.
Okay, let's talk about the focus for 2026. We talked about a number of different points, what we need to build, where we can get the product. What would you say is the company's overall focus for 2026?
Well, our focus on 2026 always begins and ends with operating safely. But beyond that, we feel there's an opportunity for us to sanction even more growth projects in Canada. We're seeing an awful lot of growth and investment opportunity in the United States, and it's attracted most of our capital over the last few years. I'd like to see us investing more in the Canadian marketplace, expanding our system in Alberta to allow gas to get to more export points and see better pricing in the Alberta market for our producer customers.
That was Francois Poirier, Chief Executive Officer at TC Energy. And following that conversation, let's take a quick look at how TC Energy has performed so far this year. Over the course of the year, look at that. You can see so far it has spiked since February, and obviously ever since this conflict in Iran has increased and continued. This is so far at least boding well for many Canadian energy companies. We'll take a look at TC Energy and how it's performing against Enbridge. These are two major Canadian energy companies, and you can see both have been really, really elevated since the beginning of this year, particularly in the last month or so. We know major energy companies obviously benefiting from what we're seeing, but as we heard in that conversation with the CEO of TC Energy, a lot of these companies are saying that we really need to start building up our infrastructure if we want to capitalize on what's happening in the Middle East right now. Okay, we'll take another quick break, but opening bells are coming up next. Stay with us. And here are the opening bells. Today at the NASDAQ, Horizon Quantum rings the opening bell. At the New York Stock Exchange, Janus Living is celebrating its initial public offering. And the TSX, Volatus Aerospace, is celebrating the company's graduation to the TSX. It's time now for the first 15. You're watching BNN Bloomberg. Trading day is just getting underway, and so we're going to check in on the equity markets to start the day. Trading lower so far today. This looks pretty similar to yesterday. The TSX, obviously, we're watching closely. It has been falling over the last couple of days, particularly amid a sell-off of precious metal stocks. So we're going to keep watching that today. Currently, it's down by 0.2% to start the morning. If we look at some of the companies within the TSX that we're going to be watching closely, obviously a lot of gold and mining companies not doing quite so well, but a lot of energy companies on the flip side doing quite well, considering what's been happening in the Middle East and Iran. Vermilion Energy is included in that. It was up the most in 2 months yesterday, topping the TSX to finish the day. This comes also as Scotiabank maintains a sector perform on the stock. But obviously, as we've been talking about, a lot of these Canadian energy companies, so far at least, benefiting from what's been happening in the Middle East in terms of the price of oil and a lack of supply at this point going through the Strait of Hormuz. So currently, Vermilion up by 0.4%. And we're also watching B2 Gold. It was the worst performing stock on the TSX to end the day on Thursday. The share price dropping along with many other gold and mining stocks on the TSX. It's down more than a percentage point to begin the day. But we're watching some others too, including Endeavour Silver and Nova Gold. Those were lagging on the TSX as well. Endeavour down by 1% as well. And Nova Gold also down by 0.7% to start the morning. So definitely watching those stocks that really rely on the price of gold and seem to drop when the price of gold drops, which it is doing. And for movers south of the border, we are now joined by Bloomberg's Janine Panzer to break down a couple of them. Janine, good morning. Thanks for joining us. We're going to start with Supermicro Computer. The stock has plunged 25% after some pretty serious allegations. What's happening there?
Yes, good morning, Lindsay. Yes, the stock has been under a lot of pressure. This comes after U.S. prosecutor charged 3 individuals in a major AI chip smuggling case involving China. The company builds the server using a lot of data centers. So it's been a big winner from the AI boom and also a key partner to NVIDIA. So what about the big legal case? Prosecutors said those charged, including co-founder, moved billions of dollars worth of NVIDIA power servers through Southeast Asia. They say that the group used fake paperwork and staged dummy servers as well. So all of this to get around U.S. export rules. The company itself is not charged and is cooperating with authorities. But analysts say the real risk here is reputational, and that could start to weigh on its relationship with partners.
You're also watching York Space, shares of this company jumping on solid revenue outlook in a debut report. So tell us more about York Space.
Yes, their shares are open higher this morning. And this company recently went public in January. The space and defense company they build small satellites and used by government and commercial customers. The moves come even though earnings misestimate, but like I said, the outlook looks pretty good. So its guiding revenue is about $545 million to $595 million and expect to turn positive on adjusted EBITDA this year. JP Morgan is calling outlook solid, pointing to growing confidence around contracts and government demand. So this is the one to closely watch in this defense space.
No kidding. There's a couple, but that's definitely one of the interesting ones. Okay, Bloomberg's Janine Panzer joining us live. Janine, thanks so much. Coming up, we will take a look on how central banks should handle inflation driven by war-related energy spikes. That's coming up next. Stay with us. Oil prices are set for another weekly gain as the Middle East conflict continues and keeps the Strait of Hormuz effectively closed. The Fed held rates, with Chair Jerome Powell saying future cuts depend on how the Iran conflict affects inflation and that it's too soon to react. However, our next guest argues war-driven energy price spikes aren't the kind of inflation central banks should fight. Let's get more now from Michael Green, Chief Investment Strategist at Simplify Asset Management. It's good to have you join us. Good morning.
Thank you for having me. It's a pleasure to be here.
We heard a similar tone from Tiff Macklem, the governor of the Bank of Canada. So in your view, how should central banks really be factoring in war inflation?
Well, I think, unfortunately, this is the byproduct of a Fed that has largely lost its way in terms of thinking truly and economically about what's transpiring in the data that they receive. They've become totally reactive to the data as compared to thinking about how they can influence it to meet their objectives. When you face a supply shortage, the answer is not to further restrict supply by hiking interest rates. The answer is to facilitate the expansion of supply by lowering interest rates. Unfortunately, we've known this for decades. This is not, any form of new economic insight. It's just been lost in the Fed's embarrassment at having mishandled the inflation coming after the COVID component. And as a result, we're repeating many of the same mistakes that occurred in the lead-ins to 2008. In 2008, we saw spiking oil prices, which were restricting consumer expenditures, tightening economic conditions, and making it more difficult for people to address the growing housing and employment crisis. Unfortunately, this looks to be the exact same phenomenon committed by the exact same institution, just with different leadership at the helm.
We are seeing similar tones, though, as I mentioned, from other central banks around the world, including Canada. So is that kind of just not the way the central banks should be looking at things when you factor in a war like this? And as you say, it's so new and really it's moving so quickly. What should central banks be looking at instead?
Well, what central banks should be doing is, again, thinking about how an economy develops, not simply in terms of a price level, but also in terms of the components that contribute to that price level, both supply and demand. The tool of interest rates can be helpful in terms of stimulating supply by lowering the cost of capital for new entrants into the market, or to rapidly develop replacement projects, or to repair projects that have been damaged. Unfortunately, we're simply focused on the idea that the price is an emergent phenomenon of unfettered demand as compared to the supply shortage. And as a result, if you're a carpenter with only a hammer, the entire world looks like a nail.
Mm-hmm. You also have referenced a recent study from Sweden, which highlights kind of what's underway in terms of when you factor in AI, when you factor in the workforce. And I'm not sure if maybe that's something else you think the central bank should be looking at. Like you say, as a result, we're seeing little firing and little hiring right now within the workforce. Can you elaborate on that?
Sure. So this is actually a report that just came out in the past few days. So Jerome Powell can be forgiven for not reading it. Not that he reads much of any interest, in my opinion. But with that said, the study highlights, it takes advantage of a unique phenomenon in which the Swedish Riksbank, their central bank, hiked interest rates earlier than other central banks, well in advance of the emergence of AI, and therefore attempts to disaggregate what was the impact of the monetary impact on employment versus the AI impact on employment. And what they found was unsurprising, that the hike in interest rates was largely responsible for the decline in Swedish employment. But much more interesting is the phenomenon that's developing within firms, and it is a byproduct of AI. Effectively, new young employees without skills are not being hired. Those would be the employees that would be traditionally trained by senior employees to raise their value and allow them to proceed down a career path. Instead, employers are increasingly using those senior employees to train AI, and assuming, and probably correctly so, that they will no longer need those junior employees. This is functionally identical to the collapse of the guild system and the apprenticeship system that occurred in the 19th century and 18th century as industrialization took off. It's going to create conditions of extremely poor returns on investment for education and training of young people. And unfortunately, it suggests that we will actually see an accelerating phenomenon of unemployment, particularly amongst the young. In the United States, we're now seeing nearly 40% unemployment for recent college grads. Again, completely consistent with the development of this model. And unfortunately, if this plays through, the next people to lose their jobs will be the actual guild masters themselves, the skilled craftsmen who know what they are doing, who have embedded domain knowledge from their experience. Once the AI is fully trained, they become expendable as well, just like craftsmen became largely expendable in the 19th century.
Interesting. Okay, I do want to switch gears a little bit and talk about the broader market as a whole and some investment strategies right now. Obviously, we're seeing a lot of volatility in the markets. It's very fast-paced, moving quickly. I wonder what your thoughts are on passive investing at a time like this.
Well, we're going to have to devote several programs to that if you want to really spend time on passive investing. But the simple answer is, the corollary to that lack of insight from the Fed is the increased lack of insight of investment processes across the developed world. Because we increasingly direct our retirement dollars into passive indexes, as long as employment remains relatively robust, that means a continuous flood of capital is coming into markets. That's fighting against discretionary managers who are evaluating the world on a forward-looking basis and attempting to discern whether or not the economy is going to develop in a favorable or unfavorable framework. And that fight between those two, effectively passive inflows from retirement where people still have jobs, is basically inflating markets. And occasionally we see discretionary managers trying to rotate against that, or discretionary market participants trying to rotate against that. That's giving us the volatility that we're currently experiencing. It's hard to know which one ends up winning. I tend to side with the passive blob.
Okay, you're right. That is a much larger conversation we'll have to get into another time because we're out of time right now. Michael Green, Chief Investment Strategist at Simplify Asset Management. Appreciate you joining us today. Thanks so much.
Thank you for having me.
Yesterday on Market Call, we were joined by Ross Healy. He is a chairman at Strategic Analysis Corporation. He was covering North American large caps. These were his top picks: Alamos Gold, Western Union, and Algoma Steel. Today on the show, we've got Greg Newman. He's Senior Wealth Advisor and Portfolio Manager at Newman Group Scotia McLeod, and he'll be taking your questions on North American equities. Coming up, we will speak to the CEO of a Canadian pharma company, Knight Therapeutics. That conversation coming up right after this. Canadian pharma company Knight Therapeutics posted better than expected fourth quarter results, with revenue climbing on strength from some key products. But the company is striking a cautiously optimistic tone on its outlook. So we're joined now by President and CEO Samira Sakhia to elaborate on that. It's good to have you join us. Thanks so much.
Thank you. Thank you, and thank you for inviting me.
Yeah, I want to get into some of these results, but just first of all, with people who are maybe not familiar with Knight Therapeutics, can you tell us a bit about your company and what you do?
Of course. So Knight is a specialty pharmaceutical company. We focus on in-licensing and acquiring pharmaceutical products, mostly for Canada and for Latin America. And we have been reporting record revenues, a record EBITDA this year, and record cash flow from operations also.
You are cautiously optimistic, though, on guidance. So why is that?
So in the last 2 years, I'm going to say in 2024, we launched 3 products. Last year, we launched 10, we had 10 launches. This year, we're expecting to have another 10 launches. The reason for caution is as these products come onto market in our various countries, whether it's Canada, Brazil, Mexico, Argentina, we need to make sure that we are forecasting our uptake curves and executing on those and actually achieving those. And in the last year, like I said, we had 10 new launches. All of these are in early stages, and we're really learning through that. We did have some of our products actually overperform last year, and we're going to continue to monitor. And if we are doing better than expectations, count on us to update our guidance.
Let's talk about some of those key products because I believe as you say, you're launching 10 this year, and you say the products address an unmet medical need. So tell us more about these products and that unmet need.
So in last year, we had 2 acquisitions in Canada, which really gave us critical mass in our Canadian business. Canada is now going to be a major portion of our business. And part of that, we had 3 products that are in early launch phase. Myfembree, which is for treatment of symptoms associated with endometriosis and fibrosis. Orgovyx, a product for prostate cancer. And also we have Xcopri, which is for treatment of epilepsy. All of these products are in early launch. All of them really address unmet medical needs in each category where patients don't have certain options or have more complex treatments. And what we've seen in the last 6 months that we've owned these, is that physicians are liking them, patients are really responding. And this is one of the reasons we're cautiously optimistic on the performance of these products, is because as physicians get more used to prescribing them, we're hoping that they will be prescribing them to more patients.
Interesting. And as you say, like some of those products that were launched last year outperformed. So you're kind of taking what you learned from last year and applying it this year. What is it that you learned and how are you applying it this year?
So in this case, because we acquired these products, each one of them, let's say within a year to a year and a half their launch, we took over. We're really new to it. We're seeing the performance. Our teams are now spending much more time trying to really understanding what is working, what is not, which physicians to also include to educate them about this product and look to accelerate. And that's really the management teams and the commercial teams really ask is, how can we do better? And that's really why we're being cautious, because we've only been on these products now for just about 6 months. As we gain more experience, we want to do better. When I look at the products that we've launched across Latin America, we have a lot of experience from the beginning, or from pre-launch, and we're executing on exactly what we wanted, and those are on track. So it's really the timing and our own experience with these products specifically to see how the products are doing and how can we Knight really capitalize on it and expand.
With these products, when you're talking about how they meet that unmet need, in general, what's the competition like in Canada for companies like yours?
So we have different kinds of competitors. Every single product obviously has other players in the market. We're really looking to, when we bring in a product, we're looking at how is this product going to help Canadians or Brazilians? Where does it place? How is it differentiated? What is the unique proposition? And sometimes, you know what, it may be a Me Too product, but we're going to try and maybe price it better. Maybe we'll give some different value. And that's really what we're trying to do in each of our markets. We don't need to have home runs, but a lot of singles and doubles will continue to build our company and really bring innovation to our territories.
Are you hoping, you mentioned Canada, Brazil, like the Latin Americas, are you hoping to expand beyond that as well this year or in the future?
We're in these markets. These markets are growing rapidly. We're in oncology and hematology. We're in neurology. We have some products in infectious disease. There's already a lot of room to grow in each of those categories. And I think as we look to continue to grow, we can get into new therapeutic areas and really take advantage of the platform that we have to continue to grow deeper where we are, deeper in our categories, wider in the number of categories, and really take advantage of the platform. We're not done there yet. But if we feel that there's an opportunity, whether it's Asia Pacific, Australia, maybe we take advantage of it. But right now the priority is to continue to build on the very unique platform that we have today.
Okay, we'll leave it there. Samira Sakhia, President and CEO of Knight Therapeutics, joining us today. Thanks so much for your time. Appreciate it.
Thank you so much.
Coming up next, we will tell you 4 things to look for if you want to quadruple threat stocks in your portfolio. Stay with us. That's next. It's called the Quadruple Threat Checklist. And for one successful investor, it's a 4-step approach to identifying standout stocks. BNN Bloomberg contributor John Ehrlichman has a new column about that on our website. John hosts the investing channel Ticker Take on YouTube. So, John, good morning. This is a strategy that's used by BNN regular Brian Madden as well. Tell us more about what it is.
It is, Lindsay. Yeah, Brian Madden of First Avenue Investment Counsel. I always love these conversations that we can have with market pros about their strategy, because in any market environment, they're helpful, but in particular this one, because right now it's hard to know where to turn. There's so many big factors and forces that are moving the stock market these days. And people sometimes get into these squabbles. I'm a fundamental investor. I'm a technical investor. In Brian's case, he says his best success has come from bringing several styles under the same roof. You mentioned that quadruple threat approach. It's 4 areas, really. It's the fundamental analysis, so what's happening with the company itself. It's technical analysis, which is obviously looking at some of the patterns with the chart. It's quantitative analysis, which in a lot of ways brings a lot of math into the investing business, but oftentimes can be extremely helpful to investors if you have access to those kinds of skills or tools. And then the macro trends, which, look, we hear this from a lot of investors, especially that we talk to on Ticker Take, certainly on BNN, that don't try to fight the tape with a stubbornly strong call if the forces are working against you. So he puts that together as his main recipe for finding good investments.
So when it comes to actually finding those good investments, what would be some example stocks?
Well, we talked to Brian about 8 particular names that he sees as quadruple threats. I thought I would focus on some of the Canadian names that he highlighted because there is some common theme to watch within all of these names. Let's take technology. So some tech stocks have come off their highs. Shopify, obviously a standout Canadian name. He likes the company in part because they are founder-led and have often gotten it right versus wrong, and there is still that great e-commerce trend playing out. Also tied to the retail area, but more traditional, Dollarama, stock that comes up on BNN a lot. Equally, a founder-led company, a company that has been very disciplined with capital. And, you know, in an environment like this, when a lot of people are thinking about what they can afford, one of the unique things about Dollarama versus, say, some of the U.S. dollar store chains is everybody goes to Dollarama and enjoys it. Plus, they're in expansion mode outside of the country. In energy, a lot of people have been watching oil stocks. In the case of one of the stocks that Brian likes, Trican, which is more tied to servicing wells, drilling, smart management team, according to Madden, and a company that made a great acquisition recently, and to round it out, Cameco, which is obviously at the center of the uranium theme. But that's a stock that's come up on Ticker Tape actually a few times, in part because you go back to that idea of capital discipline. They're in boom times, but they're still very smart about how they allocate money, how they expand, etc.
So interesting. Okay, we will leave it there. John, thanks so much for that. That is John Ehrlichman. And you can find John's story on the BNN website and his Ticker Take YouTube channel. Just ahead, we will check in on the markets, and shares of FedEx are surging. We'll tell you why right after this. Stay with us. Hi there. Welcome to the second hour of The Open. We're going to take a look at some stories that we're following for you in the BNN Bloomberg newsroom. Statistics Canada says retail sales rose 1.1% in January compared to the month before, with sales at motor vehicle and parts dealers leading those gains. The strength was broad-based, with increases in all provinces, including a nearly 1% rise in Ontario. Looking ahead, an early estimate points to a 0.9% gain in February, suggesting consumer spending is holding up despite economic uncertainty. Iran is pressing ahead with attacks on Gulf Arab states, even after Israel signaled it would stop targeting the Islamic Republic's energy infrastructure. The war has killed more than 4,200 people across the region and has brought shipping through the Strait of Hormuz to a near standstill. Iran's attacks on critical energy sites have eased from a peak earlier this week, yet crude prices maintained their rise after closing yesterday at the highest since mid-2022. And the government of Ontario is moving to protect ticket buyers from professional resellers and unfair prices. The Ford government is proposing changes to the Ticket Sales Act, which will cap ticket resale prices. Those amendments will be introduced in the coming days and, if passed, would make it illegal to resell tickets for concerts, sports, and other live events in Ontario for more than their original cost. The changes would address long-standing concerns about inflated resale ticket prices. And we're watching the markets today. The TSX is down by 0.7% to start the morning. It has, at this point, almost erased all its gains that it's seen so far this year. So we're watching that closely. Obviously, the war in Iran affecting things here at home. Precious metals are seeing a sell-off, and we're seeing that reflected in the TSX. And if we take a look at U.S. markets, investors a little hesitant there as well. Today, you can see all of those trading down at the moment. And as you just saw, North American markets now on track to fall for a fourth straight week, pressured by the war in Iran and macro dynamics, including signs of a slowing U.S. economy. For more, we are joined by David Sequeira, Chief U.S. Market Strategist at Morningstar. It's good to have you join us. Thanks so much.
Thank you. Good morning.
So aside from the war, obviously weighing on particularly U.S. markets right now, why do you think they're undervalued at the moment?
Yeah, so right now, if you look at a composite of the fair values of all the stocks that we cover, which is over 700 that trade on U.S. exchanges, over 1,600 companies, globally, U.S. market's trading at about a 9 to 10% discount to fair value. And it feels like the market in the U.S. actually does want to trade up. But as you've talked about, there's just way too much headline risk in the market right now with the ongoing conflict in Iran. As you already talked about, oil still climbing higher from here. But actually, what's even more concerning to me is if you look at the oil futures market, if you look at like the April and the May contracts, looks to me like they're actually pricing in the conflict even lasting longer than what was initially, priced into those contracts, just even a week or two ago. But it's not just necessarily Iran. So I think U.S. market is undervalued, but it's undervalued for a number of different reasons. We do have some pretty poor macro dynamics. The rate of growth in the U.S. is slowing. Interest rates have been climbing the past couple weeks. In fact, if you look at the 2-year U.S. Treasury, that's now risen enough. It almost looks like the market is trying to price in the Fed actually having to raise rates, later this year. And of course, inflation just going to be heading higher with oil prices getting higher and higher as well. So from my point of view, I think the Fed is stuck. I don't think that they can cut interest rates anytime soon with inflation rising. But at the same point in time, with the slowing economy, they can't raise rates in order to try and halt inflation as well. And then lastly, that tailwind that we've had for the past couple of years from the AI build-out boom, that has been losing a lot of steam. When I look at a lot of these AI stocks, appears to me that the market's already pricing in this year's earnings, next year's earnings growth, but getting very concerned about trying to extrapolate that growth into the 3 to 5 year forecast years. So until we get better visibility, really looking for what's going to be the driver of revenue from AI and looking for the operating margin expansion from efficiency gains, those stocks have also kind of been in a trading range for a number of months now.
There's just so many factors here affecting the markets, as you just went through all of them. I mean, gold is another one, too. And we've been talking about that today because obviously we're seeing that affecting Canadian markets here at home. Gold commonly thought of like a safe haven. That's where investors go when things are getting rough. But we've seen a sell-off this week. What do you think's been happening there?
Well, actually, I take a longer-term view on gold. And if you look at really the past 2 years of pricing for gold and look at it, compared to what it's traded on in the past, I think the dynamics of the gold market have largely changed. I mean, it used to be a hedge for inflation against geopolitical risks. It used to be that when real rates were negative, that would be when gold would do well. Conversely, it would do poorly when real rates were positive. And I think it's just a matter of how much central bank buying we've had the past couple of years. A lot of these international central banks are not price sensitive, and that's really driven a lot of momentum to the upside. So it appears to me that over the past year or two, gold's really transformed more into a risk asset than a hedge. I mean, if you look at gold spot prices, that's risen, I think, over 80% since the end of 2023. So the correlations we've seen now are much more tied towards risk assets. And I think that's why we're seeing such huge daily swings, in the gold price. Now, long term, our analysts think gold over time will back off, move down towards its marginal cost of production. But for now, so long as central banks, keep buying like they are, that's going to keep prices elevated. Now, we've recommended gold miners a number of times over the past couple of years. On my podcast, The Morning Filter, we recommended Newmont Mining in early 2024. And in fact, I checked my notes here. So on a BNN interview we had back in March of 2025, we recommended Barrick Gold. But I'm now at the point that these have moved up so much, so far, so fast. Again, I wouldn't sell out of your entire positions, but I think now is probably a pretty good time to at least take some of the profits off the table and lock in those gains.
I'm just seeing a headline coming out here on Bloomberg saying traders have priced in a 50% chance of Fed rate increase by October. I take your point of what you said at the beginning of our conversation, saying the Fed's kind of stuck here in terms of cutting rates or hiking rates, but pricing in a 50% chance of Fed rate increase. What does that do to the markets, do you think, moving forward?
Yeah, that sounds a little bit on the high side to me. I was looking not for a rate increase until much later in the course of this year. But it's so hard to tell with oil prices up as much as they have, and of course just the effect that that's going to have throughout the entire economy. And it's not just the energy markets, but it's all the other tail effects that you have. If you look at wheat, soybean, corn prices, all of those have been moving up. Fertilizer prices moving up as well. So no matter what happens with the growing season, this year, even if we have a good growing season, I think those commodity and agricultural prices also going to be affecting inflation over the course of the summer and late into the year as well.
I did want to get your thoughts on FedEx as well. We're seeing the price up by 1.5% at the moment, reporting an earnings beat. Would you be a buy on FedEx right now?
We wouldn't be. Now, granted, the results did come in much better than what we expected. Specifically, our analysts noted that they had a good, strong new account wins here in the U.S., getting higher wallet share, seeing good, business to business, wins there as well. He highlighted the healthcare and automotive industry as two areas. He also noted higher international activity, specifically Asia to Europe, has been increasing and driving good gains for them as well. Company's been getting some good efficiency gains. Now, having said all that, when we look at the stock price, he thinks the stock is already priced to perfection at this point. It is trading a little bit above his fair value. So I'd say the takeaway here is we think the market's already incorporated this into the pricing. So we'd look for better opportunities away from FedEx.
Okay, and you do have some other opportunities in terms of your stock picks. I do want to ask you about your first stock pick, Lululemon, which has been going through some tough times of late. What is it that you think there's maybe a turnaround period for this company?
Exactly. And this is one of these stocks. I think it's just a great example of how you see the stock market over time can act like a pendulum. This was a one-star rated stock at the end of 2023, one star being our lowest rating, meaning that we think it was on a risk-adjusted value basis, way overpriced. That stock has fallen a total of 67% since then. It's down 20% just year to date. But it looks to me like it's going through a bottoming process. So our fair value right now puts it at a 45% discount based on where it's trading. It's now a 5-star rated stock, which is our highest risk-adjusted rating. And there's a couple of different specific things going on here, which I think is really, positioning this stock well. So first, it actually traded up after they released guidance, even though that guidance was below expectations. I think that's a good indication that the sellers on this stock have probably been washed out, at this point. And the guidance wasn't necessarily nearly as bad as I think the market was pricing in. We're still looking for top-line growth of 2 to 4% this year. Granted, North America growth will be flat. But again, they've been competing against all these other athleisure brands for years now, so that's nothing new to the story here. We're looking for much stronger international growth, really being the driver over the next 5 years. Yes, operating margin is contracting. I think the guidance there was for a contraction of 250 basis points. But a lot of that was due to what we consider to be temporary dislocations from the tariffs. They've had to take some unusual markdowns because of some failed product launches this year. But we think these are shorter-term issues. Those will normalize over time. And then, of course, now we have activist investor involved. Elliott, they took a position last December. So we're looking for a change in management, forcing out the old CEO. So we're looking for some new blood coming in there. They're going to help that business, kind of refocus itself, getting back to its core competencies. They had a lot of ideas that they were bringing to help improve operations, more product discipline. So we're looking for, better inventory management going forward as well. When I look at our model, I think it's relatively modest top-line growth. I don't think we're pricing in anything there, heroic on the top line. And then we're just looking for those margins just to slowly recover back to normalized levels. But we don't even get back to normalized levels till 2030. Company still has over $1 billion share repo authorization remaining. Buying back stock here we think is very accretive to fair value over time. And then lastly, it's trading at 13.5 times the midpoint of their EPS guidance. And with everything going on there, I'm sure they gave what they consider to be very conservative guidance. So I'd look for further upside in their earnings this year and next.
Okay, we will leave it there. David Sequeira, Chief U.S. Market Strategist at Morningstar. Really appreciate your time today. Thanks so much.
No, thank you.
Up next, could U.S. President Donald Trump shift his focus from the conflict with Iran to Cuba as Washington continues to apply economic pressure on the Caribbean island nation? We've got that conversation right after the break. The Trump administration has ordered Venezuela to stop supplying oil to Cuba after capturing President Nicolas Maduro back in January. And it also successfully pressured Mexico to halt oil shipments, resulting in the island's worst fuel crisis in decades. As with the situation in Iran, many are asking, what is Donald Trump's endgame? So for more, I spoke with Jorge Pinon, researcher at the University of Texas at Austin's Energy Institute.
These are units that are over 40 years old. They have had very little capital improvements or maintenance over the years. And also they burn as fuel Cuban domestic crude oil, which is a very high sulfur, highly metal, very corrosive crude oil. And that's like a vicious circle. They fix the units, and within 3 to 6 weeks, they break down again. So there's a structural problem with the electric power sector. It's not a problem with fuels. And now they have on top of that, of course, that since the beginning of the year, Cuba has not received any oil whatsoever to meet their 60,000 barrels a day oil deficit.
Mm-hmm. It's a tricky situation to be in. Based on your observations or reports, like how would you describe the situation on the ground in Cuba right now, and also which parts of the island are being the hardest hit?
Well, no, now we're reaching the end of March, and we now have a level that they're facing a catastrophic situation. We're talking about no fuels, and no fuels for diesel, for example, that, as you know, is not only public transport, it's also commercial transport, it's agriculture, impacts the beginning of the sugar season in the next few weeks. So diesel is critical, and they're now running to basically the bottom of the barrel as far as supplies are concerned. LPG, butane propane, which is a fuel used in cooking on the island. That's also, for the last month or so, there haven't been any LPG delivered to consumers. So their situation now is not only electric power, but now it's also fuels. And if you look at Cuban cities from east to west, from La Habana to Santiago de Cuba, the streets are empty, and at night the whole cities are black, darkened.
We know Russia is transporting approximately 700,000 barrels of crude oil to Cuba as we speak. That's expected to arrive by about April 4th, so early April. Do you think that the Trump administration will actually permit this shipment to go through?
That's the answer that everybody is waiting for. We know that there are at least 2 Coast Guard cutters patrolling the north coast of Cuba. The Anatoly Kolotkin is carrying, as you said, 700,000 barrels of Urals crude to go to Cuba's refineries. So even the impact of that oil will take 20 to 30 days after it arrives because it has to be refined. We'll see. But by the way, the tanker that's coming on is a tanker that's been sanctioned not only by U.S. OFAC, but also has been sanctioned by the European Union. So that's an event that everybody is waiting to see what happens.
I mean, to the point in terms of our lead-in to our conversation here is why do you think the Trump administration is placing so much pressure on the Cuban economy and government right now? Like, what's the end game for Donald Trump and that administration?
I think certainly to change their economic model. As you know, there's a total communist model, total state controlling all of the industries and all of the businesses. And I guess they're trying to nudge the opening of their business model and investments. Second to that, or as a result of that, then political changes. Raul Castro is in his 90s, as well as at least 2 or 3 of the old leaders of the revolutions from 1959. So now it's a new generation. And pretty soon you're not going to have a Castro or a Castro member family in power. That will change the reaction, I think, of the Cuban people. So I think first is economic change, and they're hoping that economic change will precipitate some sort of a political change. I don't want to call it regime change, but certainly a political change down the road.
Why don't you want to call it a regime change? Like what we saw in Venezuela, do you think there's a push to do that in Cuba as well?
Yes, that model, yes. The question is, what is a regime? We don't certainly want to happen something like happened in Iraq, in which even the bureaucracy, even the government bureaucracy disappear overnight. because then you have a total social and political collapse on the island. So there's some sort of continuity that needs to be had in order for then the country to identify what their next steps are and where they want to go. So I don't like to use regime change because it means that everybody's out the door. That's not the case this time. Okay. Let's begin with economic change. Let's open the country for business and for investments. And then slowly that ought to push to a political change. Again, particularly after you have the Raul Castro and others in their late 90s, that should happen soon.
That was Jorge Piñon, researcher at the University of Texas at Austin's Energy Institute. Coming up, diesel prices have been rising faster than gasoline since the start of the war in the Middle East. We'll find out why after the break. Since the start of the conflict in Iran, oil prices have risen dramatically. However, not all petroleum products have been impacted equally. Looking at the transportation sector, diesel prices have been rising faster than gasoline prices. And here to explain why and what this means for the global economy is Tom Kloza, Chief Energy Advisor at Gulf Oil. It's good to have you join us. Thanks so much.
Nice to be here. Busy week, that's for sure.
Busy week, yeah, no kidding. Can you explain why diesel prices in particular are rising faster than gasoline prices?
Sure. Ahead of March, diesel inventories around the world were much, much tighter than gasoline inventories. You have to remember that the molecules that power a truck or a tractor are very, very similar to the molecules that are used to heat homes in a lot of places. And we had a cold winter. So a lot of those molecules went into that product. More recently, natural gas prices have gone up, not so much in North America, but certainly in other continents. And diesel is kind of the alternative for powering up a lot of stuff there. So, generally across the world, it's the highest growth product, maybe with a little competition from jet fuel. Everybody gets excited about gasoline, but gasoline is kind of the unwanted hydrocarbon sometimes.
How much has the conflict in the Middle East, though, really factored into all of this?
Oh, it's been a big deal. I mean, not only do we get crude oil from the Middle East, but we get quite a bit of diesel. There's a couple of refineries in Kuwait and the United Arab Emirates and certainly Saudi Arabia that make diesel that tends to go to the North Atlantic basin, whether it goes to Europe or in some cases to the United States. And clearly that refined product isn't coming out of the Persian Gulf right now. If you get a situation where Iran is targeting more refineries or refineries outside the Persian Gulf, it would manifest itself in just crazy high apoplectic diesel prices.
We obviously are looking at this chart right now, just so showing how much diesel has gone up. We're talking about it. We were looking. There's the chart again. So we know they've surged dramatically. But can you really put it into perspective for our viewers, like just how big of a move this is, as we're seeing that white line there just skyrocketing?
Yeah, I'll put it in this perspective. They trade with the price of crude clearly, and crude oil prices are, have moved from about $70 to about $110. So that's a big move. But the other thing that's happened is that gap between the diesel price and crude oil has widened tremendously. For the first 10 or 20 years of this century, diesel fetched a price of about $10 to $20 a barrel over the price of crude. Right now, it's fetching a price anywhere from $50 to $100 over the price of crude. So the beneficiaries, not because of any collusion, but simply because of the vagaries of the market, are really the refiners that make it, particularly if you're talking about refiners who have access to tidal waters. I remember hearing from new refineries coming up in Saskatchewan and Alberta about how, if they had access to tidal water, the world would be their oyster. And they were interested in railing it to British Columbia, to sell to China and other places.
Interesting. And as you say, like diesel is by far a faster growing product for the world than gasoline. So as you mentioned, particularly if this conflict continues and there's more strikes on energy infrastructure in the Middle East, this could just be a continuously escalating problem moving forward as there's more demand for it anyways.
Yeah, it would be the worst product in terms of one of those scenarios where some more refining gets knocked out is probably jet fuel. Because you just don't store a lot of jet fuel for one reason or another. I mean, you want to make sure that when you have jet fuel in a tank, it's up to specifications, whereas diesel can sit around a little bit longer. And if we see some more impediments there out of the Middle East, yeah, it's the product that could go to, it went to $6 a gallon back in the Ukraine war, the Russia-Ukraine war in the spring of 2022. The difference then between now and then is that war impacted somewhere close to 1 million barrels a day of molecules, they're different products. This one has impacted about 18 times as much oil that moves out of the Persian Gulf. So this is not hyperbole. They're not exaggerating when they're talking about the problems with the Strait of Hormuz being closed. It's probably costing the world another $1 billion a day just in hydrocarbon costs because of what's happened.
Wow. So what would need to change, do you think, for diesel prices to come back down? And is there a world where they do come back down, or do they stay elevated?
No, we need to get the Strait reopened, and perhaps that'll be on a limited basis. Maybe they'll do 50 or 70% of what they did beforehand. But if you don't open the Strait, then you really do bring in the possibility of $150 to $200 a barrel crude, as things manifest themselves. And, prices for diesel that look like monopoly money kind of prices, $5 to $10 a gallon and $5 to $10 a gallon on gasoline. So let's hope they open the Strait at some point. It may be quite dangerous and there may be various interruptions, but this does not get solved if the Strait remains closed.
Okay, we'll leave it there. Tom Closa, Chief Energy Advisor at Gulf Oil. Really appreciate your insight. Thanks so much for joining us.
Thanks. Nice to be here.
Coming up, what are the key wildcards that investors should be watching as volatility persists? We'll tell you after this. Statistics Canada says retail sales rose 1.1% in January compared to the month before, with sales at motor vehicle and parts dealers leading those gains. The strength was broad-based, with increases in all provinces, including a nearly 1% rise in Ontario. Looking ahead, an early estimate points to a 0.9% gain in February, suggesting consumer spending is holding up despite economic uncertainty. And shares of Super Micro are sinking today. That's after 3 people linked with the company, including its co-founder, have been charged with helping to smuggle billions of dollars worth of AI technology to China. A new lawsuit alleges Super Micro servers were used to illegally transport advanced NVIDIA chips to Beijing. The U.S. obviously imposed chip export controls back in 2022. And FedEx shares are moving higher today. The shipping giant raised its full-year profit outlook, signaling confidence in the global economy despite ongoing geopolitical turmoil. FedEx also noted that although it does not expect the war to have a direct impact on its business, rising energy prices and volatile shipping patterns are notable trends affecting the global economy overall. And we'll take a quick look at the market here, starting with the TSX, down by 1.2% today. Look at that drop off. The TSX has now given up all of its gains from this year and is below where the market closed on December 31st. It has had a rough week, and we're continuing to see it drop, particularly among the mining and gold sector, as we see the price of gold drop as well. There's only one sector on the TSX, actually, that is in the green today, and that is the consumer staples sector. So that includes names like Loblaw and Couche-Tard. Markets are navigating an unusually wide range of risks right now, from rising geopolitical tensions to concerns about asset bubbles and the impact of AI. Our next guest has laid out 9 key wildcards that investors should be watching closely, with many of them coming into sharper focus in the near term. So joining us now to break it all down is Dan Tobin, head of G10 FX strategy at Citi. It's good to have you join us. Thanks so much.
Thanks for having me.
So 9 wildcards. You've divided these wildcards into 3 central themes. What are those themes, and which one is the greatest risk at the moment, do you think?
Yes, we pretty much found, and it wasn't intentional. We came up with 9 individual wildcards, but we realized a lot of them really fell into these 3 buckets. 5 of the 9 actually fall into the bucket of, we could call this a couple of different things. I like to refer to it as the shift from a unipolar world to a multipolar world. You can think of that as greater global fragmentation, increased geopolitical pressure, and one of the 5 risks that fell into that bucket was increased military tensions and actions with Iran. This note actually came out a week before the U.S. started its campaign in Iran. So just to kind of show that these are wildcards which are meant to be, they're low probability but high impact events if they do come to fruition, and they're meant to be timely, right? These aren't wildcards that are like, this might happen this year, it might happen in 10 years, it could have happened 10 years ago. These are really meant to be based on what's happening in the world right now. These are the risks. Within that bucket, there's still a lot more. Another one that was in there that is now actually becoming a discussion point is, what if the U.S. decides to stop exporting oil? And, you can take another step where maybe it starts putting pressure on the entire America's oil system to stop exporting, oil from the Americas out to the rest of the world, which would then help keep U.S. prices lower versus the rest of the world. And you're kind of seeing that play out in the Brent WTI spread. So, I think that is the theme that is most in focus right now, and where one wild card can then tip others into becoming more likely.
Some of these themes, like, are markets underestimating how disruptive rising U.S. and China tensions, as well as U.S. and Europe tensions, could be as well?
Yeah, I think it's difficult in terms of market pricing, because these are risks that you don't really know the right way to handicap them when you're doing your fundamental forecast. So can these rising tensions lead to worse expectations for growth, for earnings? That really depends on the commodity shock that we're seeing. So it's not always clear that there's a direct translation from increased tensions to stocks need to go down, because there's not always a clear transmission for this to be worse for earnings, worse for growth. But in the cases where we are seeing higher commodity prices or higher yields because there's foreign buyer strike in U.S. fixed income, these things do start having, the more prolonged they are, real economic impacts. It really comes down, especially in the current situation that we're looking at with Iran, but more broadly, how long do the tensions last? How disruptive do they become to then actually have a real effect on the economy? We even saw it with tariffs last year, where there is effects where it can be more muted than expected. But then suddenly you get to a point where they're big enough, or they're lasting long enough, and you start having the economic impact. So I would say that the way that markets are approaching things is probably quite optimistic relative to the potential that could come in the coming years.
You've also outlined AI hitting the credit sector as a potential issue moving forward. Like, why could AI be dangerous in that sense?
Yeah, so one of the things that we've been seeing is a repricing in a lot of software, and software makes up a big part of especially the high yield credit market, in certain parts of private credit. And the big unknown with AI is just how disruptive will it be towards software. This is interesting from a credit perspective, because if you think about most credits, there's always a recovery rate. Okay, the company goes bust, but I can still get 50% of the value of the bond because they'll sell assets, et cetera. Well, with software, the asset is the IP. So the recovery rates can be much lower. And so, you might be getting 10 cents on the dollar, or you might get the full bond back. And that level of uncertainty is causing a lot of pressure on the software side. I think we're a little bit more sanguine in the sense that, it's going to take a long time for some of these disruptions to really start having broader effects. It's not clear that everyone is going to be able to build their own CRM systems, that sort of thing. So there is still probably a place for software, but this is, I think, where it becomes more of a kind of bottom-up analysis type job. There will be some companies that are severely disrupted, some that aren't. So it's probably not fair to hit the whole software sector as one. But at the moment, this is the biggest concern, and it's been a concern that's been rapidly increasing in recent weeks.
Another one of the wild cards is bursting AI bubble and aggressive Fed cuts. So how likely is the bubble to pop if we are in a bubble? And that's debatable too. And how could the Fed respond to that if that were to happen?
Yeah, just to be clear, the House base case for us is actually, CapEx spending will still help earnings. We're having a broadening in the cycle, and so we're still quite bullish on equities and tech and AI and the like as an overall theme. But there's a sentiment aspect to it. Ultimately, if markets decide that this is not something where they want to keep pushing flow towards, and we get some big, unwind, then that's a real risk. It's again, we're considering it more of a tail risk at this point in time, but that tail risk does seem to get a little fatter and fatter the more and more that we're having geopolitical tensions, growth uncertainty, and those sorts of things. So the risk has risen a bit versus maybe where we were at the start of the year, where it was a lot more optimistic. The Fed reaction function really then comes down to if that starts having an impact on growth, on spending, from a wealth effect perspective. It's something that the Fed has historically addressed. The issue will be, what if we're having that with very high inflation because it's due to a commodity shock? That's where it's going to put the Fed in a much harder spot. But if it stays purely based on a growth outlook, that's where you're very likely to see this. And this is where it actually makes a difference as to who the chair is. Because if you do have somebody like Warsh, who's a little bit more prone to cutting, on the board, and you have a backdrop that now actually justifies deeper cuts, he's going to be a lot more aggressive and kind of pushing for that. And so it's more one of those things where, if this doesn't arise, we don't really see a lot of risk for the Fed unless the data starts rolling over. But if we do have reason to cut, you're probably going to have a much more dovish Fed reaction under Warsh than you would have before. Okay, so just lastly, another wild card is perception as risk, the narrative of a foreign buyer strike. So, even if this is unlikely, how dangerous is a narrative alone? Yeah, it can be. And for us, the key thing is that when it's narrative versus fundamentally driven, it might shorten the time frame through which that theme can play out. I mean, ultimately, if it's just narrative and it's not supported by the data, there will be some reversal. So just to be very clear, there is a major concern amongst global investors about U.S. assets because of the fear that everyone else is going to want to unwind those positions. We see that as very, very unlikely. But the fear alone can then start having an asset market impact. We saw that around Liberation Day and continued concerns, despite the fact that by May and June, net foreign investors were buying U.S. assets again. But on that fear alone, that can cause problems. And we saw a lot of spikes in yields, some poor auctions because of this perceived risk that then led investors to stay away. So this still remains a very big risk. The world remains uncertain. We still have a lot of policy volatility. And the more that continues, the more that we can have a situation where foreign investors do get nervous about interest in U.S. assets and start pulling away. But again, we would really stress the idea that the actual shift away from U.S. assets is a much lower probability outcome just because of lack of alternatives versus the fear itself. That fear of such development could actually come quite quickly. So that's what we're a bit more worried about as a tail risk, is the sentiment aspect rather than the flow aspect. Okay, we are out of time, so we'll have to leave it there, but a really interesting conversation. Thanks so much for that. Dan Tobin, head of G10 FX strategy at Citi. Coming up, Hot Picks. We will zero in on 3 plays in the industrial sector right after this. Stay with us. It's time for Hot Picks, and today we are zeroing in on 3 plays in the industrial sector. Our next guest says his 3 picks are trading at a discount, creating strong valuation-driven upside. So for more, I'm joined now by Maxim Sitchev, Industrial Products Managing Director at National Bank. Good morning. It's good to have you.
Likewise. Thank you so much.
So let's begin right away. ATS Corporation is your first pick for today. What is it that you like about this company?
Yeah, it's a very interesting thesis because, we live in a very uncertain environment right now, and I'm trying to focus on names that are basically decoupled from the general GDP sort of gyrations. And given all the geopolitical uncertainty, the supply chain relocalization is benefiting automation companies. And what's critical here is that it's not just general manufacturing automation. This is really focused on healthcare, food, and nuclear, which are verticals that are growing in a secular fashion. And given the fact that the company has rolled off from electric vehicle debacle, which took place a number of years ago, right now we're facing much better EPS prospects, i.e. 19% EPS growth in this fiscal year. We have a new management team, which is really focused on margin improvements. And we think that with a much more a reasonable balance sheet, we do expect the company to embark back on M&A trail. So when you combine kind of all these things and the industrial space actually, performing relatively well in comparison to other verticals, this is one of the few industrials which has started to work this year. The stock is up 12% year to date, but we do expect materially more upside on a going forward basis. So this remains actually overall our top idea in my coverage universe.
Wow. And you say it's a global leader in healthcare with increased optionality around nuclear, especially if new builds start to materialize in both Canada and the U.S. Is that one of the main risks for the company right now if those new builds don't start to materialize as fast as you might like?
Well, listen, I don't think there's any risk from that perspective. And actually, the bulk of what they do in nuclear is refurbishment work for CANDU. So, those projects are basically locked in. And from a regulatory perspective, they have to refurbish these things. And given the big push right now, obviously, oil, where it's trading right now, I think there's actually even a bigger impetus to develop nuclear energy in North America. So more than anything else, I think actually people should be more excited about nuclear than less.
Your next pick is Bird Construction. What is it that you like about this one?
Yeah, again, the new government or relatively new government in Canada is really focused on nation-building programs and projects because, again, we're trying to decouple from the U.S. and solidify our economy. And what's interesting is that Bird derives, again, 10% of revenue from nuclear, so a very hot market for obvious reasons. Defense is another 10%. The company recently acquired capability that allows them to participate in bigger transit projects, but also ports. Again, the dual infrastructure development, I think, will be sort of all the rage. And the company also has very large presence in the industrial vertical. And given the fact where the base metals are right now, precious, obviously oil and gas developments, and some of the deferred projects that got pushed in 2025 right now resuming in 2026, such as for Dow Chemicals. There's obviously LNG, additional projects coming to fruition. It's one of these very few names that are trading at literally half the multiple of U.S. peers. And I do believe actually the management team is one of the most underrated in my coverage universe, with Tara McKibben leading the company. So I think when you kind of combine the secular growth drivers that I think are very visible and do not require decision making when it comes to capital allocation from a government perspective, I think this is a name that will continue to grind materially higher, even though the stock is already up 22% year to date.
And lastly, GFL Environmental is another one that you're picking today. Why is that?
Yeah, so very defensive. Obviously, West Management is super defensive. We picked up coverage of this name at the end of January. One of the interesting things is that over the last 10 years, there is actually the largest share price dislocation in GFL shares versus the TSX. So on LTM basis, GFL is down 10%. TSX was close to being up to 30%, and which is very, very unusual. And I think the market over-extrapolated some of the pricing dynamics. Right now, the expectations have stepped into more normal realm. And when we look on a going forward basis, we're talking about the algorithm of 5% organic growth from a pricing perspective. I do think that volumes will pick up. And critically, the leverage is right now at a materially more manageable level where the company can start resuming M&A, most likely in the U.S. So when you combine the defensive characteristics, I mean, typically waste dramatically outperforms the broader indices during the times of dislocation. Year to date, the shares are flat. I think that investors are missing the boat here. I think this is a name which you can own for secular growth trends. The fact that right now the company actually has redomiciled its HQ to the US, that means that its shares are going to be able to be included in broader indices, so bigger TAM from that perspective. And when you look at the margin improvements, decent organic growth with M&A optionality, I mean, we're talking about 12-15% CAGR in EPS for something which is trading at a discount versus U.S. peers. So again, extremely bullish on the story, especially at the current valuation.
This company, though, moving its headquarters earlier this year from Ontario to Florida, what does that signal, do you think, in terms of the outlook for the company and its priorities?
Well, I mean, it's still obviously Canada-U.S. footprint, so I mean, that dynamic doesn't change. And I mean, management, is obviously on the road all the time, visiting, all the sites, et cetera. But again, the reason for redomiciling the HQ to the U.S. was in order to be able to have deeper and better access to bigger market from index perspective. So in terms of the flow dynamic, we should expect actually this being a positive outcome for the shares, not a negative.
Okay, we will leave it there. Interesting stuff. Maxim Sitchev, Industrial Products Managing Director at National Bank. Thanks so much for joining us. Appreciate it.
My pleasure.
Coming up, we will wrap up the week on the markets as the TSX gives back all the gains it made since the beginning of the year. We'll dive deeper into that in just a moment. Stay with us.
By lies, trapping Canadians.
She's a 19-year-old girl.
W5 uncovers a crime syndicate, hunting for traffickers.
They just asked me to find people for them?
Watch W5, Saturday at 7 on CTV and Crave.
Welcome back. We're going to take a look at the markets today as we wrap up here, starting with the North American markets, all trading down today, bonds included in this. For U.S. stocks, they're actually heading for a fourth week of declines. This comes as investors are grappling with that conflict in the Middle East, those high prices of oil, and reignited fears over a recession. So we're seeing that reflected in the markets once again today. We've been seeing that throughout the last week. And if we broaden out and look at the whole week, the TSX is actually the big loser, down the most versus its peers this week. You can see throughout the week, it's down now 3.5%. It's actually erased all of its gains that it's seen so far this year, just dropping. We're seeing most of the sectors within the TSX not performing well, and that's really affecting the TSX. You can see even over the last year, down by 1.3%. As I mentioned, just erasing all of its gains. Basic materials acting as the biggest weight on the index. We're seeing a lot of the major gold and mining companies really weighing down the TSX, losing a lot of their gains as we see the price of gold dropping. And we'll talk about that in just a moment. But obviously, the big impact here on all of the markets is the price of oil as well. And it's set for another weekly surge. You can see here over the past week, up by almost 2% to end the week. This comes as the Middle East conflict continues. Brent up about 6% this week. And we're seeing no slowdown when it comes to airstrikes by Iran on some energy facilities within the Middle East, which continues to drive up these prices. And of course, the Strait of Hormuz is still very much controlled, and that also contributing to the surge in oil prices. Natural gas, throughout the last week, we'll take a look at what the price has been doing. It's down at the moment, over the last week, rather, 1.9%, so almost 2% over the last week. And we're also watching the price of gold. As I mentioned, it is set for its worst week in 6 years as the war in Iran curbs rate cut bets. The price of gold down more than 7% throughout this week, down 1% at the moment. You can see just the plummet there, particularly yesterday. And that's when we really saw the TSX start to lose hundreds of points as the price of gold also went down. We'll take a look at the loonie as well. It's rising slightly against its U.S. counterpart today. Very slightly. It's basically flat at the moment. And one stock we're watching for today is Supermicro. We've got some headlines on this. Supermicro, the co-founder, has been charged in China with some serious allegations. We've got some reports on that coming up, so definitely stay tuned. We'll tell you more about that. And that wraps up this edition of The Open. Morning Markets with Roger Peterson is next.